My dad, a hardworking school teacher, always stressed saving money. He diligently deposited a portion of his paycheck into a savings account every month. My uncle, on the other hand, invested in the stock market. My dad would proudly announce the interest earned on his savings. My uncle talked about his growing investments. As the years passed, something became clear. My dad's savings grew slowly. My uncle's investments grew significantly. This taught me a valuable lesson. Simply saving money wasn't enough. To grow wealth, I needed to make my money work harder for me. Inflation is a word that gets thrown around a lot. But what does it actually mean for your money? Inflation is the rate at which prices for goods and services increase over time. A gallon of milk that cost $2 a few years ago might cost $2.50 today. Over time, inflation eats away at the purchasing power of your money. If inflation is running at 2%, your money is actually losing value. It's crucial to grow your money at a rate that outpaces inflation. Secure your financial future by exploring ways to outpace inflation. So, how do you stay ahead of this inflation monster? One powerful tool is investing in the stock market. But what does it mean to invest in stocks? When you buy a stock, you're essentially buying a small ownership stake in a company. You become a shareholder, and as the company grows and becomes more profitable, the value of your shares can increase. This potential for growth is what makes stocks an attractive option for beating inflation. Think of it like this. If you buy a share of a company for $50 and it grows to $100, your investment has doubled in value. Even if inflation has been at 2% per year during that time, you've still come out way ahead. Of course, the stock market comes with risks, and there's no guarantee of profit. But historically, stocks have provided higher returns than more conservative investments like savings accounts or bonds. By investing in stocks, you're giving your money a chance to grow at a rate that can outpace inflation and build long-term wealth. When you buy stock in a company, you're not just betting on its share price going up. You also become eligible for dividends, which are a portion of the company's profits that are paid out to shareholders. Think of it as getting a piece of the pie for owning a slice of the bakery. Dividends are typically paid out quarterly and can provide a steady stream of income from your investments. Now, not all companies pay dividends. Some companies reinvest all their profits back into the business for growth. But for those that do, dividends can be a great way to supplement your income or reinvest those earnings to buy even more shares. This brings us to the concept of compounding, which we'll delve into in the next section. Understanding how stocks and dividends work is key to unlocking the potential of the stock market to build wealth. Section 5. The magic of compound interest. Growing your money exponentially. Compound interest is like the snowball effect of investing. It's the concept of earning interest on your interest, which can lead to exponential growth over time. Imagine you invest $1,000 and earn a 10% return in the first year. You now have $1,100. But here's the magic. In the second year, you're earning 10% on $1,100, not just your initial $1,000. As you continue to reinvest your earnings, the snowball gets bigger and bigger, accelerating your wealth-building journey. This is why starting early with investing is so powerful. The earlier you start, the more time your money has to compound and grow. Even if you can only invest a small amount each month, the magic of compounding can turn those small contributions into a significant nest egg over time. Don't underestimate the power of compounding. It's the secret sauce to building wealth in the stock market. Start early, be patient, and let compounding work its magic on your investments. Section 6. Getting investment ready, paying down debt, and building a safety net. Before you dive headfirst into the stock market, it's important to lay a solid financial foundation. This means tackling any high-interest debt you may have, such as credit card balances. The interest rates on these types of debt can be exorbitant, eating away at any potential investment returns. Once you've got a handle on your debt, it's time to build an emergency fund. This is a stash of cash set aside to cover unexpected expenses like medical bills, car repairs, or job loss. Having this safety net in place will give you peace of mind and prevent you from having to tap into your investments prematurely. Aim to have 3 to 6 months worth of living expenses saved up in an easily accessible account. By taking these steps, you'll be setting yourself up for financial success and be in a much stronger position to start investing. Section 7. Finding your investment sweet spot. Balancing spending, saving, and investing. Investing is crucial for building wealth, but it's also important to find a balance between investing for the future and enjoying the present. The 50-30-20 rule is a good framework to start with. This rule suggests allocating 50% of your after-tax income to necessities like housing, food, and transportation. Then, dedicate 30% to wants, such as entertainment, dining out, and hobbies. Finally, the remaining 20% should go towards savings and investments. Of course, this is just a guideline, and your specific allocation may vary depending on your individual circumstances and goals. The key is to create a budget that allows you to meet your needs, enjoy your life, and invest for the future. Remember, building wealth is a marathon, not a sprint. It's about making consistent progress over time while still enjoying the journey. Section 8. Choosing the right account. IRAs, 401ks, and making the most of tax advantages. When it comes to investing, choosing the right account can make a big difference in how much you ultimately accumulate. Two of the most common and advantageous accounts are individual retirement accounts, or IRAs, and 401ks. IRAs are retirement savings accounts that offer tax advantages. There are two main types: traditional IRAs and Roth IRAs. With a traditional IRA, your contributions may be tax deductible, meaning you don't pay taxes on that money until you withdraw it in retirement. With a Roth IRA, your contributions aren't tax deductible, but your withdrawals in retirement are tax-free. A 401k is an employer-sponsored retirement savings plan that allows you to contribute pre-tax dollars. Your employer may also match a portion of your contributions, which is essentially free money. If your employer offers a 401k plan, take advantage of it, especially if they offer a matching contribution. Understanding the nuances of different investment accounts will help you optimize your tax savings and maximize your investment returns. Section 9. Index funds. Your secret weapon to simple and effective investing. Now that you know about investment accounts, let's talk about what to invest in. For beginners, index funds are an excellent option. An index fund is a type of mutual fund that passively tracks a specific market index, such as the S&P 500. Instead of trying to pick individual stocks, which can be risky and time-consuming, index funds allow you to invest in a diversified portfolio of hundreds of stocks with a single purchase. This diversification is key because it spreads your risk across multiple companies and sectors, reducing the impact of any one stock's performance on your overall portfolio. Index funds are also very low cost, as they require minimal management. For simplicity, diversification, and cost-effectiveness, index funds are a great way for beginners to get started in the stock market. Section 10. Navigating market volatility, understanding and managing risk. The stock market is inherently volatile. Prices go up and down, sometimes dramatically, in response to news, economic data, and investor sentiment. It's essential to understand that volatility is a normal part of investing and not something to be feared. In fact, market downturns can present buying opportunities for long-term investors. One of the best ways to manage risk is to have a long-term investment horizon. This means not panicking and selling your investments when the market inevitably experiences a downturn. Remember, time is your greatest ally in the market. The longer you stay invested, the more opportunity you have to ride out any short-term fluctuations and benefit from long-term growth. Embrace the long-term perspective, and don't let short-term market swings derail your investment strategy. Section 11. The long game. Patience and consistency in the stock market. Investing in the stock market is a journey, not a get-rich-quick scheme. It requires patience, discipline, and a long-term perspective. The key is to develop a sound investment strategy, stay informed, and stay the course even when the market gets bumpy. Remember, the stock market is driven by emotions in the short term, But logic and fundamentals prevail in the long run. Don't get caught up in the hype or try to time the market. Instead, focus on what you can control: your savings rate, your investment choices, and your emotional response to market fluctuations. Stay disciplined, keep learning, and over time, you'll be well on your way to achieving your financial goals. Investing is a marathon, not a sprint. Be patient, stay consistent, and enjoy the journey to financial freedom.